Now let's bring in Trivariate Research's Adam Parker, Apollo Global Management's Torsten Sloke. Adam, a CNBC contributor. It is great to have you both with us. Adam, I'll begin with you. Is everything hinging on a so-called pivot at this point from the White House?
I think in the next few days, yes. It's hard to see how we'd have a big rally without some sense that this isn't going to be a prolonged trade war. The way I try to think about it is I think what's happened is 1 year of earnings growth has been already taken out based on lower consumer confidence, management teams not knowing what to do. So maybe my 2026 earnings are now my 2027 earnings. Maybe that's okay because so many stocks are down 15, 20% that maybe they're discounting that 1 year already. And so it's getting close as we tried to, you and I danced around the last couple of weeks talking about. I think it's getting close. What I think is true, and then I got a little concerned I was wrong already, is that the tariff news wasn't going to get worse, that 34% number would be the biggest I was going to hear. And then while I'm in a meeting with a couple hundred people on today, I see a 50% number come across the screen, and I thought, whoa, So I think if the tariff news doesn't get worse, we can start focusing on earnings guidance and the stock action and maybe get to a brighter day later in the year. But I'm still too nervous based on what I'm seeing, today.
Torsten, it's good to welcome you to our program today. How does that match up with your own view?
Well, I think that the challenge at the moment is that we should probably assume that tariffs are going to stay in place. There could be some reductions coming, but if tariffs are going to stay in place, of course, it will, over the next several quarters, begin to have negative consequences for earnings and for GDP. It could drag GDP down as much as 1.5%, and at the same time put 1.5% upward pressure on inflation. And combining that with weaker corporate confidence, weaker consumer confidence, uncertainty about retaliation, and now on top of that, the negative wealth effect of the stock market being down $7 trillion. All those things are just weighing on the economic outlook going forward. So it is just the case that the outlook here is still being dragged down by a number of negative forces weighing on the economy.
Adam, I hear a description of stagflation without saying the word, but that really is what the great fear is here, is it not?
Yeah, for sure, that's terrible for stocks if that happens. But I think what the plan is, and the administration has been consistent that they've been worried about trade imbalances and that they've been consistent about tariffs. But the other part of the plan is that they're going to try to offset some of that with taxes and tax relief being extended and with regulation that could help offset it. And so I think in order to get the Republican Congress to agree to the tax deal, they could start pressuring the administration if some of this stuff really starts hurting their constituents. And I was sort of half joking in my note on Sunday, but you got $1/3 $1 trillion lost from some of the Mag 10 CEOs who, in my recollection, had better seats than Usha Vance at the inauguration. Like he's probably going to get some text from those folks at some point too. And
yeah,
you could start
seeing give your million to lose billions.
Yeah,
nice trade.
Yeah, good trade there. You buy the Washington Post and you lose $200 billion personally, or whatever. So I think there's some stuff like that where they could start getting pressure. I'm not saying it's at 5,000 and that's where the put is. I still think it's too early to take risks. But I think at some point you'll need that tax agenda and regulation agenda to be on the minds of people, not getting worse every day on tariffs.
Torsten, you paint a scenario which sounds to me that is one where there's no confidence at all in what earnings could actually be. And if you don't know what earnings are going to be, and because you don't know what the economic environment is going to be, then you have no clue as to what the multiple should be on this market and what investors would be willing to pay for stocks. Therein lies the underlying issue for this market.
Absolutely, and therefore volatility will likely continue. And adding to that, the really unusual development today is what's happening in rates. Normally, when the stock market goes down, long rates and short rates should be going down. But long rates today went up 25 basis points on a day when stocks are going down. This was likely driven by a combination of factors such as supply worries. It's also what's going on in credit spreads widening out. It's also probably general risk reduction. There's worries about whether this is a basis trade unwinding. But there really is a very fundamental question about if the risk factor, meaning the factor that I use to discount my stock cash flow earnings over the next several years with, if that's also going up, then that does increase even further the volatility in markets, because then it's only not a question about what are future earnings. It's also a question about what is my discount factor. And if that's now suddenly higher, that creates a lot of things that are problems for valuations going forward.
Let's stay on the earnings thing for a minute. Yeah. You share those concerns, like you don't have any visibility on what you think earnings are going to be.
No,
How are you going to
I don't think
map this whole thing out if you don't have no idea?
If you and I were running a company, CEO, CFO, we report next week. We're having a meeting.
Who's who?
You were the CEO. You see how I did that? I
making sure.
Yeah, I was clear. But we will be having a conversation about what should we guide to make sure we don't foul up this July earnings guidance. The skew to that's got to be the negative. Why would we set the bar high where we can't meet it? With all this uncertainty, we don't know what our consumers are saying. We don't know the capex of our customers. They know they're going to keep cybersecurity and nothing else. I mean, we're worried. So we're going to set the bar low and hope the market digests it. We have no choice. So I'm worried that the guidance will be bad. On Torsten's point, the one thing I've learned, and this could be like everything I'm saying, this could be wrong. But what I learned at Morgan Stanley during all those years was the supply-demand argument is not a good argument for bond yields. Okay, it just isn't. When people are afraid, almost always the 10-year yield goes lower. Operation Twist, Torque, QE1, QE2, QE3, EC, all that stuff. Morgan Stanley's guys were saying, oh, supply is coming on and it'll back up, and every single time yields went lower because people are afraid they buy the 10-year. On a one-day basis, you can have weird mechanical stuff, but if the economy slows, I'll make a bet strongly the 10-year yield goes lower over time.
But there is part of a concern. I mean, I know people are talking about it. Whether you get a policy protest from foreign governments who then start unloading treasuries, which starts the move higher in yields. I mean, that's an issue to potentially contend with if it ever ends up happening.
No, and I agree with Adam, of course. Under normal circumstances, if the economy and equities go down, then rates will and should go down. That's why today is so unusual. Let's just agree that today there was more supply than demand, and that was the reason why rates went up. That's why it becomes so important to understand and think about why are rates moving up today. The dollar actually went up today, so it doesn't look like this is foreigners selling. It doesn't look like this is China selling. So it must be some domestic selling, which is why it could be basis trade unwind. It could be just risk reduction on the equity side, risk reduction on the credit side. But the fact that rates are moving up is creating a lot of homework for investors for the following days.